Today is Monday, February 8th, 2021, and I'm your host, Max Gottlich, and I talk about my insights and interpretations into financial markets and the global macroeconomy. Well, the 30-year yield rises to about 2% more or less. Brent crude's trading at like a year high around $60, and corporate profits are up 55%. So you're probably thinking thus far that the economy is doing well. And I'll have you know that you're extremely misguided and you need to check out my other videos and really start taking note of the truth. Because although corporate profits are up 55%, a recent Fed survey, done by a variety of Fed banks, it showed that just under 90% of companies said that they still had not returned to pre-pandemic levels. In fact, another stat I saw that I found was interesting was that 1 in 3 of these companies say without government support, they're very unlikely to survive. So no, we're not even close to a stable economy. It just looks like we are because artificially low interest rates, a crazy expansion in deficit spending, and expansionary monetary policies, all these things are simply delaying the inevitable debt and liquidity crisis. And we should also note a pretty important milestone for the inflation narrative that the 10-year TIPS inflation break-even rate actually reached its highest point since 2014. That's a really big deal. And of course, the stock market bubble is blowing up into really just an even larger bubble as households' equity ownership really increases to its highest point in over 20 years, since the internet bubble. And I think treasuries have picked this up, and they'll continue to, even though there really is the high likely scenario of that yield curve control of that, of these Fed tapering programs, but really only time will tell for certain. We can only tell with the data that we have, and we can't really tell what the Fed will do. Like we've generalized before, the Fed typically does the wrong thing at the wrong time. And I'd like to focus on today's show on the velocity of money, which, put simply, is really just money that is in circulation, or the frequency of that, of currency transactions. And the chart you see now is the velocity of M2 money supply, which really is just the most common way of measuring money velocity. I think it is. Most people measure it with M2 aggregate. And this chart really goes back to like 1960. The peak you see there occurred at around Q3 97, 1997, that is, at around 2.20. And ever since Q3 1997, it's really just been declining to record lows, and record lows today, that is. And based on where M2 velocity is right now, a dollar was used, what is it now? 1.129 times in the past year. That's all it is. So for every dollar that was turned over 1.129 times in the economy within that year. And so what this decline from the internet bubble to current day tells us is there is a decrease in the amount of transactions, right, occurring between all these individuals, within the economy. So despite all the fiscal checks coming into people's hands for free, and these people reinvesting those checks into stocks, data simply tells us that people are holding their dollars and they're paying off debt, but they're not really spending. They're not spending much, at least. And thus production output actually decreases. So you see a higher velocity would indicate stronger consumer demand and increasing production. So essentially it's the rate of turnover in the money supply, where you literally just divide the sovereign's GDP by the velocity of the sovereign's currency. In our case, it would be USD. And we've talked about M1 and M2 many times before on the show. And just to remind you that M2 is really just a combination of M1 and, like CDs, savings accounts, money market funds, all these things. So it's obviously just a more broader aggregate measure of money supply than M1 is by itself. And there there's even a more broad aggregate measure of liquidity, which is the money with zero maturity, which is everything M1 and M2 plus financial assets, right? And M1 and M2 doesn't have anything to do with financial assets, but the money with zero maturity takes into account financial assets that are redeemable at par on demand. So it should be very clear now that money velocity declines, in large part to a massive increase in the money supply, right? And that means, of course, banks are not lending really much at all because interest rates are too low. So there's really no profit incentive for banks to lend in the first place. In fact, that's how nominal GDP is calculated. You just multiply money supply by money velocity. It's very simple. Well, this is all I have for you today. I hope you enjoyed watching, and please subscribe to the channel and like the video. And also note, I'm not a financial advisor, and everything I say is entirely for informational and educational purposes only. Okay, thank you, everybody.